This conference will now be recorded.
Good afternoon and welcome to the London Academy of Trading weekly market insights for Friday the 14th of January. My name is Paddy Osborne. I am the Dean at the Academy, and we're going to have a look, just a sort of recap on what happened this week, and we're going to have a look ahead to next week and see what sort of things are in the news for us to look out for in our trading for next week. So first of all, this week was rather strange in the fact that it's not been like many other weeks that where the dollar in the currency markets anyway, the dollar has been pretty strong over the last few weeks, but this week it was much weaker. If we have a look at the data that we saw this week, there's a couple of events particularly that actually prompted some further weakness in the dollar. Just stepping back from that a second, in the longer term, in the last few months, we've basically seen the Fed becoming more hawkish. So the Federal Reserve, they're looking to, well, they certainly are now, they've confirmed they are tapering their quantitative easing. So they were pumping $120 billion a month into the financial markets for several months to recover the economy back from COVID. And they've now decided a month or so ago that that's now going to be tapered away down to zero by March. So that is the first thing. They're not flooding the market with dollars anymore, which the market has seen as obviously dollar positive. And also the plan is, and the expectation in the market is that interest rates in the US will start to rise. And of course, the higher the interest rate for any commodity, then the more attractive it is. And so as interest rates rise in the US, then the attractiveness for the dollar increases, and so the dollar goes up. So what we've seen for the last few weeks is a strong dollar. So euro dollar down, sterling dollar down, etc., etc. But just this week we saw, and I'll see in a chart in a minute, that in fact we'll look at it now, the euro has been going up, and this is partly the euro doing okay, but it's also partly, and I think mainly, the weakness of the dollar. Now it's a rather strange reactions really, because these two events that I've circled here, the testimony of Jerome Powell on Tuesday and then the inflation data that came out on Wednesday, they were not obvious dollar weakness type pieces of data. So if we look at the first one, Powell's testimony, if I just go back to the calendar, you can see here, it was here 3 o'clock on Tuesday. He testified to Congress, and he basically repeated what he'd been saying before, that the plan is to taper the QE. The plan is that the thought about maybe raising interest rates 2 or 3 times this year, possibly even 4, some people think, but certainly interest rates in the US will be significantly higher by the end of this year than they are now. But it wasn't anything new. And so on the back of that, I think the market had priced in a little bit more hawkish view. And so when he didn't come out particularly excited about any of these things he's spoken about already and didn't come out with anything new, the market actually sold off the dollar somewhat. So we can see the reaction there. It was a decent move in euro dollar. It was about, about 40 pips over a couple of hours. So it was a decent enough move. We then had an even bigger move the following day. So this was Wednesday, just after lunch, 1:30 data came out, and this was here the CPI. So inflation data from the US. The headline figure is actually this one, so I'm not sure why it's not a red event. The previous month was 6.8, which is hugely high, and the highest it's been for about 40 years. The expectation was 7%. For this month or for December, and it came in exactly in line with expectation. So basically, what we're looking at here is, why did the dollar go down? Because in fact, the other measures of inflation, which is excluding food and energy, were slightly, just 1/10% higher than expected. So the expectation there is actually the dollar might be a little bit firm. However, I think despite the consensus in the market being 7% and 0.5 and 5.4 as they are there, I think actually the market had already priced in a little bit higher than that, so possibly up towards even 7.5% for this main CPI figure here. It came in as expected at 7, which was in the end slightly disappointing, and then it prompted some selling of the dollar, which obviously boosted euro dollar pretty quickly, and there we see it going up about 45-50 pips in just 1 hour. So those were the two real sort of bits of impetus that we saw overall through the week, from Monday lunchtime, the low down here Monday lunchtime, so week euro strong dollar Monday morning, but then from lunchtime Monday it actually went up 200 pips up to the highs that it reached on Thursday, And in fact, what's happened now, I've just drawn in this sort of channel line here to illustrate this sort of 1 week trend, but we've also really got at the moment some sort of reversal pattern going on. So we've got, it looks a little bit like it might be some sort of double top going on here. We've also got some other confirmation. We've got bearish engulfing candlesticks in here. So the rejection off these highs has been quite aggressive over the 1 hour period. And also we've got what's called bearish divergence. So just a little bit of technical analysis here. You can see here as the market went up to the 2 highs, which were the same level, both up here at 114.80, the strength of the market and momentum of the price move was decreasing, suggesting potentially that we could get a break out of that green box, which we've got. We've had a little retest since the data came out, but the trend looks to be continuing. Well, it looks to be reversing. The 1 week trend looks to be reversing, which is actually the longer trend continuing. So if I stretch this back this way, you'll see the longer trend is definitely in one particular direction. And that is, and it goes back a lot further than that. Let me just take it to a 2 hour chart so we can see a little bit further back. You can see the trend is definitely euro down, dollar up. And just this week, it now stands out. You can see there that rebound that we've seen in the euro, in fact, the fall back in the dollar. One of the other reasons for that potentially is looking at the interest rates in America. So I'll just take it back to a 1 hour chart, and I'm going to go and look at US yields. So this is the 10-year yield, and we can see here over the last weeks, this is a peak again. This was lunchtime on Monday, and that was the high point. That's the highest that the price, the yield has got. It got above 1.8% for the 10-year bond yield. So this is the US government bond yield. And of course, if the bond price, the yield goes up, it means that the dollar becomes more attractive. So the dollar was going up, and this was, as we've seen in the past, but this week we saw it drifting down, and at the same time we saw the dollar drifting down, euro going up, sterling going up against the euro, the dollar, etc. So currencies have been a little bit badly behaved, if you like, this week, because they've not been behaving quite as you might expect from the fundamental data that came out, and also it's gone against the trend that we've seen. So up until this week, really, it's been a pretty safe bet to be long of the dollar. But this week it was quite a significant 200 pip reversal, and so that would have taken out quite a few of the long positions that have been built up over the last few weeks. Having a little look at equity markets. So most equity markets, the FTSE and the DAX have been relatively quiet and sideways and not that interesting. But if I just stretch this one out a bit, you can see here we've had a few little sell-offs in the S&P. So we are below where we started the week. So the week started around here. We had a sell-off Monday morning, recovery, a little bit of up, but then a couple of sharp downs again. So we've had a couple of rather poor days to finish the week, and so the week will end on a negative note. We're down about 200 points from the all-time high. So last week we registered yet another all-time high in the S&P, up here at 4,820. We're now down there at 4,625, 29 or so. So it's about 200 points down from the highs last week. So it's just starting, or stock market's just starting to get a little bit wobbly. If you think about, stock market investors, if there's less money being pumped into the market, so quantitative easing is declining as the Fed is doing, a lot of that money tends to find its way into the stock market, and that has been one of the features that has been boosting the stock markets, particularly in America, over the last several months, certainly since COVID, even the last couple of years now, nearly. That's now drying up, and so the expectation is that there won't be quite so much money flooding into the stock market. At the end of the day, the performance of the companies in the stock market is what drives the price. And if all these companies in the US continue to make good profits, then P ratios and all the other ways that they calculate the value of the stock, it should still be a decent investment. But there's just not so much money and a bit sort of fluff, I don't know, it's just spare money, if you like, has been going into the stock market, and that's what's been holding it up. So we've just seen recently a little bit more volatility, a few of these sort of sharp downward moves in equity markets, and so it's just showing some signs in the US anyway of just, it looks like it's showing the characteristics anyway of looking towards the third phase of a major bull market. We've had a fantastic bull market from March last year. It's had a fantastic, unbelievable 2-year run up, over 100% increase in most of the markets in the US, and just starting to look a little bit nervous that we might not be seeing much higher levels than this year. Okay, just a quick look forward to next week on the economic calendar. I don't really need to go and look at it, but we've got a few things. Actually, let's just go and have a quick look at it. So I'll just go and find it here. Right, so if we go next week. And what have we got? So basically, we've got some Chinese data overnight on Monday morning, but that's not really very well traded. So we're really looking further forward. So Tuesday overnight, here we've got the Bank of Japan. They got their interest rate decision, so look out for the yen on that one, and the Nikkei. We've got unemployment data, claimant count, average earnings, all this good stuff from the UK, 7 o'clock Tuesday morning. So that should affect the pound, and of course we'll see all that on the news across the UK. Wednesday, we've got inflation, really. We've got UK inflation data coming in at 7. We've got also the German inflation data coming at the same time, just here. And then we've got the Bank of Canada announcing their Canadian CPI at 1:30. So there's a lot of inflation data coming out Wednesday, which could cause a little bit of fluctuation around the place. And then the final thing really to look out for is this Australian unemployment coming in just after midnight on Thursday morning. So again, that might cause a little bit of a volatility for the Aussie dollar. Okay, I hope you had a good week of trading this week and have a good weekend, and we'll catch up with you again next week. But I hope you have a good trading week for next week. Take care. Thanks. Bye-bye.